For decades, you've probably heard the same advice. Save as much as you can in your 401k or traditional IRA, and for good reason. These accounts offer valuable tax advantages while you're working. Your investments grow tax-deferred, allowing your retirement savings to compound over many years. But there's an important detail many people don't fully understand. Eventually, the IRS requires you to begin withdrawing money from most traditional retirement accounts. These withdrawals are called Required Minimum Distributions, or RMDs. For many retirees today, RMDs generally begin at age 73, depending on your birth year and current IRS rules. Here's what surprises many people. You may be required to withdraw money even if you don't need it. Whether your living expenses are high or low, the IRS requires a minimum annual distribution based on your account balance and life expectancy. And because traditional IRAs and most 401k's were funded with pre-tax dollars, those withdrawals are generally treated as ordinary taxable income. Let's look at a simple example. Imagine a retiree has $800,000 saved in a traditional IRA. Once RMDs begin, they may be required to withdraw tens of thousands of dollars during the first year alone. Even if that money isn't needed for everyday expenses, it still becomes part of their taxable income. And that's where things begin to connect. A larger taxable withdrawal doesn't just increase your federal income tax, it may also affect how much of your Social Security becomes taxable. And in some situations, it can even influence the amount you pay for Medicare premiums. This is why retirement tax planning isn't only about growing your investments. It's also about deciding when and how money leaves your retirement accounts. Many financial professionals encourage retirees to create a withdrawal strategy years before RMDs begin, giving them greater flexibility while tax rates may still be lower. The earlier you understand these rules, the more planning options you may have available. Because the next rule builds directly on this one. For some retirees, higher taxable income doesn't stop with taxes. It can also increase the cost of Medicare. After age 60, your retirement doesn't just change, your tax rules do too. And if you don't understand them, they can quietly reduce your retirement income year after year. The surprising part is that many of these rules aren't new. They've been part of the tax system for decades, yet millions of retirees don't discover them until they've already paid more than they expected. In today's video, I'm going to walk you through 5 retirement tax rules that every American over 60 should know. We'll cover why your Social Security could become taxable, why the IRS eventually requires withdrawals from retirement accounts, how those withdrawals may affect Medicare premiums, a hidden tax effect that can make retirement withdrawals more expensive than expected, and one planning opportunity that many retirees miss completely. Understanding these rules early can help you make more informed decisions and potentially reduce unnecessary taxes over time. Before we begin, a quick disclaimer. I'm not a CPA, attorney, or financial advisor. This video is for educational purposes only and is based on current U.S. tax laws and publicly available information. Always consult a qualified tax professional before making financial decisions. If you're new here, welcome to Decoding Finance, where we simplify retirement, taxes, and personal finance into clear, practical guidance. Now let's begin with the first rule. Rule number 1. Your Social Security may become taxable. One of the biggest surprises in retirement is learning that Social Security benefits aren't always tax-free. Many Americans spend decades paying payroll taxes into the Social Security system. Naturally, they assume the benefits they eventually receive will come back without additional federal income tax. But depending on your overall income, that isn't always how the system works. The IRS uses something called provisional income to determine whether part of your Social Security becomes taxable. This calculation includes other taxable income, tax-exempt interest, plus 1/2 of your Social Security benefits. If that combined amount exceeds certain IRS thresholds, part of your benefit becomes taxable. For some retirees, up to 85% of their Social Security benefits can be included in taxable income. That doesn't mean an 85% tax rate. It means up to 85% of the benefit is considered taxable income under federal tax rules. Many retirees first notice this after taking withdrawals from an IRA or 401k, receiving pension income, or earning investment income. Most retirees expect their Medicare costs to stay relatively stable, but what surprises many people is that your income can affect how much you pay for Medicare Part B and Part D. This adjustment is called the Income-Related Monthly Adjustment Amount, IRMAA. Here's the important part. IRMAA isn't based on how healthy you are. It isn't based on how often you visit the doctor. It's based primarily on your reported income. If your income exceeds certain IRS and Medicare thresholds, your monthly Medicare premiums may increase. And this catches many retirees by surprise because the income triggering those higher premiums often comes from sources they didn't think would create a problem. For example, required minimum distributions, RMDs, large IRA or 401k withdrawals, capital gains from investments, pension income, certain one-time financial events. Individually, these may seem manageable. Combined, they can push your income into a higher Medicare premium tier. Here's another detail many people overlook. Medicare generally looks at your tax return from 2 years earlier. That means a large withdrawal today could affect your Medicare premiums 2 years from now. Many retirees receive a notice about higher premiums and wonder what happened. The answer is often hidden in financial decisions they made years earlier. This is why retirement planning isn't just about this year's taxes. It's about understanding how today's income decisions may affect future healthcare costs as well. Fortunately, there are planning strategies that may help reduce this impact, depending on your individual situation. Working with a qualified tax or financial professional can help you understand how withdrawals, investment income, and retirement distributions fit together. Because here's where things become even more interesting. Many retirees believe they know their tax bracket. But in retirement, the effective tax cost of an additional withdrawal isn't always as straightforward as it seems. That's exactly what we'll cover next. Individually, none of these income sources seem unusual. Together, they can increase provisional income enough to change how Social Security is taxed. Here's why this matters. Many retirees focus only on their tax bracket. But retirement planning is often about managing taxable income, not simply earning less. Small income decisions today can sometimes affect taxes more than people realize. And that's exactly why understanding the next rule becomes so important. Because once you reach a certain age, you may no longer have complete control over when retirement money comes out of your accounts. So let's quickly recap. After 60, retirement isn't just about saving money anymore. It's about keeping more of what you've already earned. Understanding how Social Security taxes work. Planning ahead for required minimum distributions. Managing Medicare premium thresholds. Avoiding hidden tax stacking. And making the most of your low-income planning years. These aren't just tax concepts. They can shape how much retirement income stays in your pocket over the years. The good news is this. None of these rules are meant to catch you off guard if you understand them early. With thoughtful planning and guidance from a qualified tax professional, many retirees can make informed decisions that may help reduce unnecessary taxes and avoid costly surprises. If today's video helped you understand even one retirement rule you hadn't heard before, let me know in the comments. Which of these 5 surprised you the most? Just type 1, 2, 3, 4, or 5. I read every comment, and your feedback helps decide what we'll cover next. If you found this video valuable, please like, subscribe, and turn on notifications so you never miss future retirement and tax planning updates. And if you know someone in their 60s or someone already enjoying retirement, share this video with them. One conversation today could help them make better financial decisions tomorrow. Thank you for watching Decoding Finance. I'll see you in the next video. Until then, stay informed, stay prepared, and take care of your financial future.